This is your technical update from the LMAX Exchange Research and Analytics Desk for Thursday, March 5th, 2015. Euro dollar. So it's important to understand where the euro may be headed after the market recently broke down below 10.98, which was the 11-year low from the 26th of January. The break now puts the market at its lowest level since November of 2003, and the move confirms a lower top at 15.35, which could open the door for a measured move downside extension over the coming weeks into the 106.65 area. Having said that, it's also important to note that the weekly studies on the euro are highly oversold, and if we look at these studies on the RSI, the market is trading below 20 on the weekly RSI, which does warn of an extreme bottom and an extreme low, and the potential for some form of a correction before the market resumes the downtrend. But back to this daily chart, the market has to break back above the recent high from Wednesday at 11.85, or let's call it even breaking above 112, to take the immediate pressure off the downside and open the door for the possibility of a correction in the euro. Until then, the pressure and the focus remains on the next key psychological barrier at 110. Sterling dollar. So cable has nicely failed off of recent highs at the 155 after rallying above 155.50, and the market looks like it's poised for a bearish resumption and putting in a lower top here ahead of the next downside extension back towards and below the recent 2015 low at 49.51. Wednesday's break and close below 53.15 does a good job of confirming or strengthening that outlook, while at this point only back above Wednesday's high, which comes in at 53.72, would compromise the immediate bearish outlook. Dollar yen. So with dollar yen, the market has been locked within a very, very well-defined and very strong uptrend and has deferred to a period of consolidation over the past few months. Right now, the key focus is on a retest and break of the 7-year high from December at 120.185, above which exposes the next extension towards the 125 area further up. At this point, any setback should continue to be very well supported by this previous triangle resistance, which comes in around the 117 area, while only back below 115.55 would give reason for pause. Euro Swiss. So Euro Swiss has enjoyed a nice recovery over the past several weeks since that violent drop-off that we saw, and the market is now consolidating just under recent highs at 108.15. There is risk for additional pullbacks over the coming sessions, but while the market holds above 104.15, the recovery is favored through 108.15 and towards next key psychological barriers at 110 further up. Only back below 104.15 would give reason for pause in this recovery outlook. Aussie dollar. So Aussie has been content on deferring to some consolidation, which is classified as a bearish consolidation given the broader underlying downtrend, and the market though will need to break below this consolidation low at 76.25, which is also a multi-year low, to confirm the next downside extension into and towards the psychological barrier at 70. At this point, only a break and close back above 79.13, that recent high that we saw on the 26th of February, would give reason for pause and open the door for a potential additional corrective activity before the market looks to resume the broader downtrend. Dollar CAD. So dollar CAD has also been consolidating over the past several days, with the market consolidating gains off of recent multi-year highs at 128 that were set on the 30th of January. Overall, the market is now looking for the next medium-term higher low ahead of a fresh upside extension towards the 2009 peak at 130.65, but we shouldn't rule out the possibility, if the market does break below recent range lows at 123.50, for a more significant correction down towards the 119.50 area before the market considers bullish resumption. At this point, really, it's waiting to see whether we get that break of 128 or 123.50. Of course, right now into Thursday, 123.50 looks like it could be compromised first. Kiwi dollar. So the New Zealand dollar has rallied up in recent days to previous and key previous support at 70 in the 76 area, which had been a low from 2014, and the market is expected to find a lower top at some point over the coming sessions in favor of a bearish resumption. The downtrend is firmly intact on a more medium-term basis, and so this 76 area should be a formidable resistance point in favor of that bearish resumption. Ultimately, a break back below 71.76 would confirm, but look for a move below recent lows at 75 to strengthen this outlook and accelerate declines. Really, only a break and close back above recent highs at 76.14 would compromise this outlook. SPX 500. So after triggering a double top on the daily chart, the SPX 500 has been consolidating around the 21 area, and the market focus is now on a break of the low that we saw on the 17th of February at 2083. A break below and a close below that level will do a good job of confirming a more meaningful top and accelerating declines for a more significant correction in the index. However, a break back above the recent record high at 2120 from the 25th of February would negate and expose further highs towards next key psychological barriers in the 2150 area. Gold. So gold has been attempting to establish a higher low over the past several sessions in the 1190 area, with the market looking like it's forming a more significant medium-term base off of the 2014 low at 1131. But for now, a break above the recent high at 1223, the high from the 2nd of March, would be required to strengthen this outlook and accelerate gains back towards the recent 1308 highs and towards 1345 further up. Only a close below 1190 would compromise or delay the recovery outlook in gold. That's all for now.